Well, I never thought I'd be saying this, but after 5 years of being a shareholder, I just sold out of one of my favorite dividend stocks. Unfortunately, I'm talking about Starbucks. I can't even believe I'm saying it. This one wasn't easy, guys. If you've been watching my channel for any extended period of time, then you'll know I've always had a soft spot for Starbucks. I love my Starbucks. I literally drink their coffee every day. We buy the beans for home. And without exception, I sip it out of my Las Vegas mug from their Been There series. That plus a good book is my favorite way to start the day. And just so you know which mug I'm talking about, it's this bad boy right here. They have this series of mugs for pretty much every major city, and it's just a fun collectible thing. And my wife and I, we've got probably a dozen of these. Now, when I first bought into Starbucks, which I did as a brand new investor back in 2020, I thought I was picking up one of the coolest dividend growers out there. Starbucks has one of the biggest and best brands in the world, with what seemed like strong pricing power, although their increasingly high prices are one of the things many customers are starting to not like about them, but still they generally have a pretty loyal customer base and an incredibly simple business model. It's not hard to wrap your head around how Starbucks makes money. Now, at the time when I first bought into Starbucks, they'd been growing their dividend for somewhere just north of a decade, and the underlying business was strong enough to support that growing dividend. While 2020 was a rough year, the payout ratio before then had historically been pretty low, typically between 40 to 50%, as we can see right here. And with that, the company had incredibly high returns on invested capital, above 25% on average, really strong, and was generating enough free cash flow to comfortably cover the dividend, with free cash flow payout ratios also between 40 to 50%. All in all, Starbucks seemed like the textbook example of what a long-term dividend investor should want to own, but fast forward a few years and the story has started to shift. It's no surprise to say that Starbucks has been in full turnaround mode over the last several years, and the financials during this time, really since 2021, have been on the down and out. Taking a look at the free cash flow over here using Snapstock, which you can start using right now to do your own stock research and analysis. There's a link to this in the description of the video and in the pinned comment. But here we can see that from 2015 to 2021, the growth of the free cash flow was pretty consistent. You know, the trend is definitely up and to the right, with exception of 2020. That was obviously a tough year, but excluding that, we can see some free cash flow growth here for sure. But since 2021, it's kind of moved in the opposite direction, and it has started to go back downhill, going from 384 in this year to 244 in the trailing 12 months. Along with the declining free cash flow, we can see that the margins are deteriorating as well. The net profit margin has gone from 14.5% in 2021 to 8.6% in the trailing 12 months. So it's almost been cut in half. And we'll see a similar trend here with the free cash flow margin. In 2021, it was sitting at about 15.5%, but once again, in the trailing 12 months, it's been cut in half, and it's now sitting at 7.6%. So the trajectory's not really been great these last few years, and simultaneously, while the free cash flow has gone down and the margins have declined, the company has taken on considerably more debt. In 2019, the net debt was sitting at about $8.5 billion. In the trailing 12 months, it's almost tripled, and it's now sitting at $23.34 billion. And with this increase in debt, we can see that the interest coverage has suffered as well. In Q2 2024, so basically this time last year, the interest coverage ratio has gone from 10.74 to 4.72 as recent as Q1 2025. Now, to justify this increasing debt, management has always pointed to the high returns that they get from new store openings. I've heard them talk about this for years, and obviously opening new stores is a big part of the company's growth strategy, but this explains why they've felt comfortable borrowing so aggressively. With that said, though, the combo of declining free cash flow with the declining margins, while seeing the debt go up so much, all of that's starting to get a little bit too sketchy for my liking. Like I said, though, the company is trying to get back on solid ground, and the Back to Starbucks plan that's currently being implemented is the company's attempt to get things back on track. And if you just listen to the earnings calls, you would walk away pretty optimistic that things are heading in the right direction. Still, the more that this story is playing out, the bigger the gap that I'm seeing between the confidence on the calls and what's actually being reflected in the numbers. Getting into the most recent quarter here, Q3 2025 was the company's 6th straight quarter of declining same-store sales. Plus, earnings per share was down almost 50% year over year. And the company is now officially paying out more in dividends than they're generating in free cash flow, which is not good. And this is not the first quarter where that's happened. Looking at the last 3 quarters, Q1 2025 actually was pretty solid. The free cash flow payout ratio was exactly 50%. They generated $1.22 in free cash flow while paying out 61 cents in dividends. So that's good. But the next quarter was the complete opposite. They actually saw saw negative free cash flow, negative 26 cents, but they still paid out 61 cents in dividends. So the dividend was not covered by free cash flow there. And then this most recent quarter, Q3, they generated 38 cents per share in free cash flow while still paying out 61 cents in dividends. Not great. And if we combine the numbers from these last 3 quarters, in total, they generated $1.34 in free cash flow while paying out $1.83 in dividends. So they're paying out more in dividends than they're generating in free cash flow. And just based on these 3 recent quarters, the free cash flow payout ratio comes out to about 137%. So that's not great. To be fair though, a lot of the pressure on their free cash flow right now makes sense when you zoom out. This company is in turnaround mode. And so they're spending big right now to overhaul operations and try to reposition the brand, like I said earlier, to try and get back on solid ground. One of the things they're doing is rolling out the Green Apron service model across every US company operated store starting this month in August, which is a full rework of their operating playbook aimed at speeding up service and improving consistency. Along with that, they're also moving away from mobile order only stores and focusing on revitalizing existing locations with a more inviting atmosphere and comfortable seating, hoping to bring back that third place feel. They want people to come and hang out. So in a lot of ways, this declining free cash flow isn't just a result of poor performance, it's also a byproduct of the investments they're making back into the business. And truth be told, I think a lot of these moves that they're making are actually pretty well aligned with what people have always loved Starbucks for in the first place. And that's a big reason why I didn't sell my shares sooner. It's because I actually liked what they were doing. Still, taking everything into consideration, here's where I ultimately land. I'm afraid that in the midst of all these investments, paired with the deteriorating financials, that the dividend is going to be sacrificed in the process. If we look at the earnings payout ratio trend over the last handful of years, once again since 2021, we can see it has dramatically increased, going from about 50% to now about 90% in the trailing 12 months. And looking at it on a quarterly basis, the most recent quarter that we have here, which is Q1 2025, was well over 100%. Now, don't get me wrong, I truly hope that my gut instinct is wrong about all of this. I really hope that they don't cut their dividend, but when you get to a point where you are consistently paying out more in dividends than you're bringing in, there's really only so long that you can keep that up. And as much as I do love this company, I really do love Starbucks, I just didn't want to wait around to see how this would play out. So I figured it would be best to just bow out while I was ahead. If we take a look at the sold positions page over here using my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. I ended up selling my entire position, all 78.06 shares, on July 30th at $93.53. So with an average cost of $86.34, I did see a slight gain. Overall, I was up 8.3% just looking at the share price, including the dividends that I'd received over the years, which was about $421. My total return with Starbucks was 14.6%. And as we can see here, since I sold, the share price has gone from this $93.53 down to $89.71. And it wouldn't surprise me to see it dip back down into the low 80s or even back into the 70s like it was earlier this year if the comps and the margins don't turn around. And honestly, that might create an opportunity to buy back in at an even lower price than my original cost basis, which I would not mind. Now, regarding what I've done with the proceeds from this Starbucks sale, so far I've reinvested it into a few different positions in my portfolio, a few that I feel like I can sleep better at night owning. So far, I've added 16 shares to WP Carey, believe it or not. This is the first time in a long time that I've added to WP Carey. But anyway, I ended up buying these shares at $64.03, not a bad price. But along with that, I've also added 8 shares so far to my Zoetis position. You guys know I've been buying this one left and right. So this is just a continuation of that, and I picked up these shares at $147.91, a very solid price if I do say so myself. And I also continued my dollar cost averaging in Procter & Gamble. So far, I've picked up 9 shares at an average cost of $150.65. And so far, this is what it looks like on the dividend income side of things. Starbucks was bringing in $190.46 in annual dividend income for me. So I've been working to replace that. So far with WP Carey, the shares that I picked up added $57.60 back. With Zoetis, that added $16 back. And with Procter & Gamble, that added $38.07 back, which means that I still have $78.79 of dividend income to replace to break even from the sale of Starbucks, and that will be a piece of cake, guys. As we can see here, I still have just over $4,000 that I need to reinvest back into my portfolio. And based on the math, math, I will only need to reinvest at an average yield of 1.95% to make up that difference in income. And realistically, what I'll probably continue to do is just buy the same 3 companies. Procter & Gamble for sure. I'll continue adding Zoetis. Why not? I might pick up a little more WP Carey, but I think I'll likely go a bit heavier into Procter & Gamble and Zoetis for the time being. But either way, I think we're going to come out ahead in terms of dividend income. With all of that said, as far as Starbucks goes, loving the company and loving the stock are 2 different things, and they're just not aligned right now. As much as I wish they were, they're not. And I do hope that at some point in the future, those 2 things do come in alignment again. And it doesn't look like I'm the only one to sell out of Starbucks. In this next video right over here, my main man Russ also made the difficult decision to liquidate his shares as well. Much more often than not, Russ and I are on the same wavelength when it comes to these things. And I think he did a great job of laying out his reasoning. So click right over here to check out his video, and I'll see you in the next one.